Well, the SABC News a special focus on the two-part retirement system in a partnership with Sanlam. Well, the two-part system, as you've just heard earlier on, will officially kick on the 1st of September. Today, we're now joined via video link by Director for Personal Income Tax, Marle van Niekerk from National Treasury. Thank you so much for your time this afternoon. As you can imagine, there's so much uncertainty around this, whilst also a little bit of excitement. But firstly, I want us to take a couple of steps back by, unpacking what the key differentiators are between the current retirement system and the two-part retirement system, in as far as, of course, the existing retirement savings and future savings are concerned.
Thank you. Thank you very much, Renate. I think that is exactly the right place to start. The current system that we have in place has a few problems with it. We definitely, as Treasury and as a country, we need to see higher levels of savings. And in the current system, a lot of people withdraw their full pension pot, everything that they have saved up, every single time that they change jobs. To the extent that when we did the discussion paper, the latest figures at that point in time was that in 2018, there was a leakage from the retirement system amounting to almost 80 billion rand per year from people taking their full retirement savings when they change jobs. So the old system, while it is not a bad system, still had a lot of leakages. And progressively, over time, Treasury has had a number of retirement reforms in an attempt to have a better retirement system that encourages savings from South Africans. So what we're trying to address is two big problems that are in the current system. The first is these big leakages, which mean that people may have saved up to a certain point at which they withdraw their full retirement fund, and then they start again from zero. When they get to retirement, they find that they have a balance, but it's much smaller than it would have been without these very large withdrawals. That's the first problem that we're trying to address. And then the second problem is that overall, sometimes people are afraid of saving because no one knows what the future holds. And it means that if they get into financial distress of some sort, they are very worried about having all of their savings locked up. And that is the innovation that we have with the new savings component, which says that when life happens and you have a true emergency, at least you will have a little bit of an option to make a withdrawal, but it can never be the full entire value of the fund. It can only be up to a third. That's in a nutshell what the old and the new system would entail.
Yeah, and I mean, we understand, of course, that it would then be three parts, essentially, the vested, the savings, as well as the retirement. But there is, of course, a concern. I mean, I hear what you're saying in as far as the current system is concerned. The concern here is that whilst there might be some form of relief for many indebted workers, especially, the amount of tax, depending on the tax bracket, of course, will be too high. So just by way of an example, what can people really expect here in as far as, how the tax will affect their take-home amount is concerned? Okay,
let me maybe just quickly explain how we get to the rates, and then I'll do an example of what it means once you make a withdrawal. Maybe the first point to make is whenever you save for retirement through a pension fund, a provident fund, or a retirement annuity, everything that you put away that is up to 27.5% of your taxable income is deductible. And there are very few people that get over that limit. So for most people, it is fully deductible, which means that you don't pay tax on it at that point in time. The agreement between government and a pension fund member there is because you are putting this money away and you cannot spend it at this point in time, government doesn't tax it at that point in time. Everything that grows in the fund doesn't attract any tax while it is in the fund. It is only at the point that someone makes a withdrawal from the fund that tax is applied. Now, in the past, we had these big lump sum tables where people, if they make a withdrawal, for instance, when they change jobs, they would then attract rates of between 0 and 36%, depending on the size of the withdrawal. That was not necessarily fair, because if that person had zero other income, but they had a big withdrawal, they would have a high tax rate. And the rest of our tax system works in such a way that your rate is determined by your level of income and what you are able to spend. So in this new system, if you make a withdrawal from the savings component, it will be added to your gross income, which means that it attracts exactly the same tax as you would have paid for any other type of income. If you make a small withdrawal, it probably means that it will be at your current rate of tax. If you make a very large withdrawal, it can potentially put you in a higher tax bracket. For people who are in an emergency of some sort, say for instance, someone lost their job and they don't have any other form of income, it would effectively mean that they have a much lower rate of taxation because our tax threshold is at about 95,750 Rand a year. Yeah. So if the withdrawal and the other income is not over that, then it would mean that they do not pay tax. So by way of example, say for instance, we take someone who is earning a salary of about, or has taxable income of 500,000 Rand a year. They would currently pay the marginal rate of 31%. If they were to take a withdrawal of, say, 50,000 Rand, that would then be added, and it would mean that they now go to the next tax bracket, which means that on that amount, there would be a rate of between 31 and 36%, which is a slightly higher rate. So that is how it would work in a nutshell.
Yeah. I mean, just listening to that previous interview there with the SARS commissioner, SARS is warning that those who wish to withdraw first, they first need to have registered with SARS and also be in compliance with SARS, you know, from a tax status point of view. And considering, of course, we are in tax season, what are the options here and what do people have to bear in mind?
Okay. I think the first thing to bear in mind is if you have any questions about how this will work for your particular retirement fund, the best place to get that information is the retirement fund itself. For the retirement fund to contact you with, for instance, a statement of your benefits or any communication about these big reforms, they need your up-to-date contact details. So that would always be the first point, in my opinion, is check that your retirement fund has your correct contact details and get information from the retirement fund itself. The second thing I would suggest is before making any withdrawals to get really good financial advice. And the reason for that is, remember, any withdrawal that you make, you're not just getting that sum, you will be getting that sum minus tax for starters. But also you will be giving up retirement income. So think carefully about what the future implications would be from actually lending from your future self in a way. And then thirdly, not to be under pressure from anyone else. Any fund member has worked hard to save for retirement. And it's good to help people when we can. But to first take care of yourself, your current and your future needs. With regards to SARS, it's always a good idea to check your compliance status. And if there are people that are still considering to file their taxes, I would definitely encourage people to do so. If you think that there are any problems with your compliance status, to contact SARS via particularly the electronic channels, firstly. To see that those are sorted out before making a withdrawal so that you don't get a very nasty surprise later on. The fifth thing I would suggest is that every fund is setting up systems at this point in time to implement the new law that comes into effect from the 1st of September. So I think we should all just have the expectation that we will not necessarily be able to make withdrawals on the 1st or the 2nd of September. That will be the new date for the new system from then on. But keep in mind, calculations will have to be made from the 31st of August in order to determine different values in different components. So not to be in a rush to expect withdrawals and money in our pockets immediately. And
I mean, just from a tax perspective, what a lot of people actually don't know is that if you do owe SARS money, they will take some of that money too, over and above the tax that they will charge, so that they correct that particular debt. But also, Marle, as we are speaking, it is important to also know that I think what has come with this reform is to allow people to take the third, of their savings in their retirement funds, or up to 30,000 rands, whatever it is, without having to actually resign from their jobs to cash out their pension, which was what was happening. So in a way, this is somewhat of a good news and a silver lining, I would say, for those workers that were doing that particularly.
We certainly think so. And in a country where employment is difficult to find, you don't want people to necessarily give up employment in order to make a lump sum withdrawal. Indeed, what we hope to see over the next few years is that people become much more cautious about taking large lump sum withdrawals before retirement. There is some level of flexibility because there can be emergencies, but that there's a lot more transparency because people will see immediately that has an impact on the total savings that they will have available in their retirement fund.
Thank you so much for your time and, of course, just unpacking some of those questions that we had today. Marle van Niekerk is from the National Treasury, and she's a personal income tax director.